Welcome to the deep dive. Today we're going straight to what you might call the source code of rational finance. We're unpacking the philosophy Warren Buffett himself famously called, well, the best book on investing ever written.
That's right. We are diving deep into Benjamin Graham's classic, The Intelligent Investor. And Graham, he isn't just some historical figure. He really is the foundational pillar, the father of value investing.
It's amazing how relevant this book still feels. It first came out in, what, 1949?
1949, yeah. And yet it offers such timely wisdom, especially for navigating, the constant market noise and the kind of volatility we see today.
So that's really our mission here, to give you the essential mental models Graham developed. Because let's face it, we're overloaded with information, right?
Yeah.
Graham offers a way to get clarity.
A powerful defensive strategy, really.
Exactly. This deep dive is like a blueprint for making rational decisions. And the focus isn't really on getting rich quick, is it?
Not at all. It's much more about the core promise of learning how not to lose money first. Honestly, if you can just master the principles we're going to talk about, you've probably insulated yourself from, 90% of the mistakes most people make.
Okay, let's get into it then. Let's unpack Graham's philosophy, starting with what feels like the first, maybe the most critical psychological split he makes. What's the fundamental difference he draws between the investor and the speculator?
Right. This is the absolute starting point of the whole book. Graham basically said the investor approaches buying stocks as acquiring actual ownership in a real business.
Like buying a piece of a company.
Exactly. So their decisions are anchored in, rigorous analysis, long-term discipline, and really understanding the underlying value and having that margin of safety we'll talk about.
Okay, so that's the investor. What about the speculator? What defines that mindset?
The speculator, well, they view stocks completely differently, more like tickets to be traded. They're mostly interested in which way the price is moving.
Driven by sentiment, tips.
Yeah. Market sentiment, short-term trends, maybe some tip they heard. They're focused on guessing the next quarter, maybe the next month. The investor, on the other hand, is thinking about the next decade.
It reminds me of that famous analogy Buffett often uses, paraphrasing Graham.
The weighing machine versus the voting machine.
Exactly. In the short run, the market is a voting machine. That's the speculators, right? Casting votes based on popularity, hype, fear.
Whatever the mood of the crowd is. But crucially, in the long run, the market becomes a weighing machine.
And what does it weigh?
It weighs the actual substance, the underlying business reality, its earnings, its assets, its cash flow. The votes, the popularity contest, that only matters for a little while. This is really why Graham's work is so timeless. It perfectly describes every single market bubble and bust cycle we've ever seen.
Yeah, thinking back over the last couple decades, the dot-com boom, or even some of those, recent surges in unprofitable tech stocks.
Classic examples.
Those were all periods where the voting machine was just absolutely roaring, weren't they?
Absolutely. Those were classic Mr. Market getting euphoric. Times when the price had just completely detached from any reasonable measure of intrinsic value, the actual weight, and the intelligent investor's job during those times, it's basically just to wait, patiently, for the weighing machine to eventually do its thing.
Okay, that patience idea leads us right into pillar 2. Graham himself apparently said this was his single most important concept, the margin of safety. You mentioned it just now. It sounds like financial armor, but can you really define it for us?
The margin of safety is, at its core, a simple but powerful rule. An intelligent investor must never overpay for an asset, full stop. It's the practice of buying a security only when its market price is significantly below what you've calculated its real intrinsic value to be.
Okay, significantly below. That implies there's some calculation involved first, determining what a company is truly worth. That sounds like the real heavy lifting, doesn't it?
Oh, absolutely. That's where the discipline really comes in. Graham, writing back then, focused heavily on things you could really measure. Concrete stuff.
Like what, specifically?
Historically, he often favored buying companies for less than their liquidation value, what you could sell off the assets for, or based on very conservative, proven earnings multiples. The goal was always certainty, or as close as you could get. You're looking for stability. Stability in assets, stability in earnings, something that gives you real confidence in your baseline valuation.
Okay, so let's say you've done that homework. You've rigorously analyzed a business, crunched the numbers, and you figure its true worth is, say, $100 per share. How does the margin of safety rule actually work then?
Right, so you've got your $100 intrinsic value. The crucial part is you must resist the urge to buy it just because it seems okay, like at $95 or even $90. You wait. You wait until Mr. Market offers it to you, maybe at $70, maybe even less. That $30 difference, that is your margin of safety.
And the whole point of that $30 buffer is protection.
Entirely protection. It shields you first from being wrong in your initial analysis. Because let's be honest, valuation is part art, part science. Even if the true value was really only $90, well, you still bought it at $70, so you're okay.
Right, makes sense.
And second, it protects you from just sheer panic when the whole market decides to take a nosedive, which it inevitably does sometimes.
So it's your cushion against mistakes and against broader market meltdowns.
Exactly. It's the ultimate risk mitigation tool. It helps ensure that those inevitable market fluctuations don't turn into permanent losses of your capital.
Okay, so margin of safety is our defense against getting the analysis wrong or getting caught in a crash. But what about just handling the day-to-day craziness, the emotional roller coaster? Graham gave us that brilliant tool for that famous parable, Mr. Market.
Ah, Mr. Market, yes. It's such a fantastic piece of behavioral finance insight, way ahead of its time. It personifies the chaos, the irrationality of the stock market perfectly. Graham asks you to imagine you have this business partner, right? His name is Mr. Market. And every single day, he shows up at your door.
Rain or shine.
Every day. And he makes you an offer. He'll either buy your share of the business from you or he'll sell you his share.
But he's not exactly stable, is he? What about his mood swings?
Oh, he's completely unstable. Graham describes him as basically manic depressive. Some days, maybe the news is great, the sun is shining, he's absolutely euphoric. On those days, he might offer you a ridiculously high price for your share, maybe 10 times what the business is actually worth.
Okay.
But other days, maybe there's recession talk or some geopolitical crisis, he's utterly depressed, convinced the sky is falling. On those days, he'll show up desperate to sell his share to you at an absurdly low price, maybe even half of what you could sell the assets for.
Wow. And the lesson in all this for you, the listener, is absolutely crucial, isn't it?
Paramount. Graham stresses, you are never obligated to accept Mr. Market's daily offer. Ever. His job is just to show up and give you a price. Your job is to decide if that price makes any sense based on your own analysis and your margin of safety.
So you basically ignore him when he's being crazy.
Exactly. And you potentially take advantage of him when he's being irrationally pessimistic.
Which leads directly to that classic investing rule.
Be greedy when others are fearful, and fearful when others are greedy. Graham teaches you that market volatility isn't your enemy. It's actually your friend. Provided you've already done the work to figure out the intrinsic value, volatility creates the opportunities to buy low from a panicked Mr. Market. You have to exploit his mood swings, not get swept up in them.
That really shifts the focus, doesn't it? From analyzing the company to analyzing the investor, analyzing yourself. Let's move into that second section, looking at the practical strategies and the psychological mastery needed, starting with defining yourself. Because Graham recognized not everyone can, or even should, try to be a full-time stock picker.
Exactly. He was very realistic about the time and temperament required, so he defined two main paths. The first is the defensive investor. And honestly, Graham felt this is the right path for the vast majority of people. This investor prioritizes safety above all else. They want broad diversification, minimal effort, minimal stress.
The sleep well at night portfolio.
That's the goal. And the modern strategy for that defensive investor, it's become incredibly simple, really, and very effective. Consistent long-term investment in low-cost, broadly diversified index funds, like an S&P 500 ETF or a total market fund. You basically get market returns without needing to do individual company analysis.
Simple, but powerful. Okay, so that's the defensive path. What about the other one?
The other path is the enterprising investor. Now, this is for the individuals who genuinely have the time, the passion, and, frankly, the analytical skill to do deep professional-level research. Their goal is to actively hunt for those specific stocks that are genuinely undervalued, the ones Mr. Market is currently mispricing significantly.
Okay, and for that enterprising investor, the book gives some clues about what to look for. This isn't just a casual glance at a stock chart. It requires real homework.
Real homework, yes. You need solid evidence of things like consistent earnings over a good number of years, a proven track record, and a healthy financial condition. That usually means relatively low debt compared to equity and positive, reliable cash flow, financial strength.
And then there's that crucial element, the one Buffett really emphasized later, the durable competitive advantage.
The moat.
Ah, the moat. Yes, that's absolutely critical because if you're going to put in all that effort to find an undervalued company, you need some confidence that its profitability won't just get competed away tomorrow. What stops competitors from coming in and eating their lunch? That's the moat.
Can you give us a sense of what a modern moat might look like? It's not always just about being the biggest, is it?
No, not always. Think about structural barriers. It could be strong network effects, where the service gets better as more people use it, like a social media platform, or maybe very high switching costs for customers. It's just too painful or expensive for them to move to a competitor. Or it could be an intangible asset, like a super powerful brand name that people trust implicitly, or maybe critical patents.
Yeah.
Without some kind of durable moat, a company's high profits are basically just an open invitation for competitors to pile in and drive those returns down. That brings up a really interesting question for someone thinking about being an enterprising investor today. I mean, in a world dominated by huge institutional funds, lightning-fast algorithms, is it still realistically possible for an individual enterprising investor to find those truly undervalued gems? Or has that edge kind of disappeared?
That's a fair question. And look, that edge is definitely harder to find than it was in Graham's day. No doubt about it. The markets are more efficient in many ways. But I wouldn't say it's been eliminated entirely. The intelligent individual investor's advantage today really lies in, I think, two main areas: time horizon and specialized knowledge.
How so?
Well, algorithms are great at processing vast amounts of surface data very quickly, but they usually operate on shorter time frames. An individual who can genuinely understand a specific niche industry operating within their circle of competence, as Buffett calls it, and who is patient enough to wait maybe 3, 4, 5 years for Mr. Market to recognize the value, that person still has a potential advantage. Opportunities often arise precisely because others are either rushing, speculating, or panicking and selling indiscriminately. The patient, knowledgeable investor can step in.
Patience and understanding your niche. That makes sense. And it leads us right back to the psychological side, which some people call the 80% rule of investing.
Yeah, the idea that success is maybe 20% strategy or mechanics and 80% behavior and psychology.
And the core insight there, from Graham, seems to be that the investor's biggest problem, their worst enemy, it's usually themselves.
That's the absolute genius of Graham, I think. He understood this decades ago. Calculating financial ratios, analyzing a balance sheet, that's the relatively easy part. Anyone can learn to do that. The hard part is controlling your own emotions. It's the failure to stop that short-term market noise, that manic Mr. Market voice in your head, from overriding your carefully reasoned long-term valuation and your margin of safety.
So what does that psychological mastery actually look like in practice? Let's say the market tanks. The S&P drops 30% in 3 weeks like we've seen happen. What does the intelligent investor do? Or maybe what do they not do?
Mastery looks like discipline. In that scenario, your gut, your fear response is absolutely screaming at you, "Sell, get out, stop the bleeding."
No. The intelligent investor, steeped in Graham's thinking, recognizes this as Mr. Market having one of his severe depressive episodes. They see assets potentially going on sale, fire sale prices even. If they have cash and find opportunities meeting their criteria, they might actually be buying when everyone else is panicking.
And the flip side, during a roaring bull market, a bubble, same discipline, different emotion. When everyone's euphoric, the media is proclaiming a new era, and your neighbor is bragging about their crypto gains, mastery means overcoming greed. It means refusing to chase prices higher just because they're going up. It means sticking to your valuation discipline, even if it means sitting on the sidelines for a while.
I think most of us can probably admit, if we're honest, to feeling like a genius right before a big market drop. It's incredibly difficult to keep that ego and those emotions in check.
It absolutely is. Which is why Graham put so much emphasis on temperament over just raw IQ. He knew it wasn't about being the smartest person in the room.
Okay, so to kind of bring all these ideas together and see how they evolved, we really have to look at Graham's most famous student, right? Warren Buffett.
Yeah.
How did Buffett take this foundational philosophy and maybe refine it or build upon it?
Buffett is brilliant at distilling complex ideas. He took the core of Graham's emphasis on protection and famously boiled it down to those two simple rules. Rule number 1, never lose money. Rule no 2, never forget. Rule no 1.
Which really hammers home that capital preservation, the whole spirit behind the margin of safety, is absolutely job one.
It's paramount. And then the second key refinement Buffett made was really around the quality of the business you buy. Graham, especially early on, often focused on buying statistically cheap companies, even if they were kind of mediocre businesses, The cigar butt approach, finding one last puff.
Right, buying fair companies at wonderful prices.
Exactly. Buffett, along with his partner Charlie Munger, gradually shifted that focus. They realized it's often far better to buy a truly wonderful company at a fair price. Why? Because a high-quality business with a strong, durable moat is likely to keep compounding its value year after year, decade after decade. Even if you didn't get the absolute rock-bottom bargain price initially, the long-term compounding can make you much wealthier.
Quality becomes a key part of the value equation itself.
Precisely. And the final piece, which connects back to that enterprising investor idea and understanding niches, is the circle of competence.
Only invest in what you truly understand.
You got it. If you can't explain simply how a company makes money, what its competitive advantages are, what the major risks are, then you're not really analyzing it. You're just guessing. You're speculating.
Which brings us right back to pillar one, that fundamental divide. If you can't analyze it, you are, by definition, a speculator in that instance.
Exactly. You've got to know the boundaries of your own knowledge and stay within them.
Okay, so we've covered a lot of ground here. Graham's core principles, the psychological defenses you need. What does this whole blueprint really mean for you, the listener, starting today?
Well, the action plan really begins with some honest self-assessment. First, you need to define your investor role. Realistically, are you a defensive investor? Should you be focusing on those simple, low-cost, diversified funds and just letting the market do its thing over the long term? Or do you genuinely have the passion, the time, the analytical skills, and crucially, the temperament to be an enterprising investor? Be really honest about your limitations and interests.
That self-knowledge seems key. What's next?
Second, internalize that margin of safety concept. Make it absolutely non-negotiable in every investment decision you consider if you're going the enterprising route. That means committing to doing the valuation work up front, however you define it, and then having the patience, the discipline to wait for Mr. Market to offer you a price that gives you that significant buffer, that protection.
Patience again.
Yeah.
And the third piece.
Third, and maybe the hardest day-to-day, commit to tuning out the noise. The daily hysterics on financial news channels, the sensational headlines, the endless chatter on social media. Focus entirely on the weighing machine, the long-term business fundamentals, not the short-term voting machine. Filter ruthlessly.
Sound advice. Now, of course, we absolutely must include the critical disclaimer that comes with any discussion like this, straight from the source material itself. Investing always involves risk. That includes the potential loss of your principal, your starting capital. This discussion is purely for educational purposes. It is not financial advice. Please, always do your own thorough research or consult with a qualified financial professional before making any investment decisions.
Absolutely critical. But maybe we can leave you with the ultimate lesson from Benjamin Graham. What he really taught us, I think, is that success in investing doesn't actually require extraordinary intelligence. It doesn't require amazing luck either. It's much more like a marathon. It's defined by discipline, by patience, and crucially, by emotional control.
So the true intelligent investor, whether you choose the defensive path or the enterprising one, is ultimately defined by their steadfast temperament. Mastering your own mind, your own emotions, that might just be the most profitable investment decision you can ever make. Keep digging into those fundamentals, cultivate that patience, and maintain that steadfast temperament. Until the next deep dive, keep learning.